would you do if your mortgage repayments suddenly increased by more than 60%? The Reserve Bank expects 880,000 borrowers to fall off the mortgage cliff when their fixed rate expires in 2023. So how can you avoid this nightmare and cushion the fall? Reduced payments, capitalization, loan extensions, and interest only are some options that lenders could offer to help borrowers. Each option has its advantages and disadvantages. The most suitable option depends on your situation, the lender's internal policies, your loan status, and your loan terms and conditions. The common benefit of all these options is that it could help you with cash flow and may give you time to improve your financial situation while you wait for the interest rates to drop. The main downside of all these options is that you could end up paying more interest charges in the long run. But this might be a good trade-off to keeping you and your family in your home. Let's look at a case study to see how these options could impact the household budget and potentially create a softer landing from the mortgage cliff. This is Jake, and Jake is a single dad of a 4th grader named Tom. They live with their best fur friend, Bob, in a 3-bedroom townhouse in the inner suburb of Melbourne. Jake bought his property in 2017 with his ex-wife. They split up soon after, and his current fixed rate of 2% is ending in December 2023, and we're in July now. His loan balance is just under $623,000, and his property is worth around $814,000, which gives him a LVR of 76.5%. This is important because the lower the LVR, the more options Jake has. But here's the problem. If interest rates keep going up, let's all hope that doesn't happen, then Jake will face a huge jump in his interest rate from 2% to potentially 7% by the end of 2023. The current average variable rate in Australia is 6.04%. That means Jake's monthly payment will go from $2,739 to $4,471 at the end of this year. Jake needs a plan now. But first, Jake needs to look at his finances to figure out what his limit is. Jake works as a structural engineer and earns $7,300 per month after tax. After paying for all expenses and cutting out any unnecessary spending, he is left with $4,300 per month to cover the mortgage. So we can see immediately that Jake cannot afford his mortgage repayments if interest rates go up to 7%. Now, he could try to save some more money by having everyone take cold showers and eat baked beans on toast for most meals, but we all know that that is not a long-term solution. Jake needs a better plan. Jake's LVR gives him some options, but his main challenge and risk is serviceability in the face of potentially rising interest rates. So how will the options that we mentioned at the start of the video work for Jake? Reduced payments is when the borrower pays less than their normal monthly repayment for a short period of time, but the missed payments has to be made up later. If Jake enters into a special agreement with his lender and pays the maximum that he can afford, which is $4,300 every month for 6 months, then Jake would need to catch up on $1,026 worth of payments after the arrangement ends. This option could help Jake in the short term with cash flow. But what if Jake can't catch up with the missed payments after the special arrangement period ends? This is where capitalization could help. Capitalization is when the missed payments are added to the loan balance and spread over the remaining loan term. It means that Jake won't need to catch up on the missed repayments of $1,026 after the reduced repayment period. So this option may increase Jake's monthly repayments slightly for the remaining of the loan term. One very important thing to be mindful of is that reduced payments and capitalization could help Jake if interest rates start dropping soon. But they are not suitable solutions for Jake if his mortgage interest rate stays at 7% or goes up further. Jake could end up in trouble fast. What about extending the loan term? This is when the loan is extended up to the maximum allowable term. Jake has 24 years left on his mortgage, having already paid 6 years off. If Jake extends his loan term to 30 years, then at 7%, his monthly payment will be $4,145. Bingo! Jake can afford that. But this is very close to his limit of $4,300, and it doesn't leave much of a buffer room. When we're looking at budgets, it's always a good idea to leave some wiggle room, because the one thing that we all have to consider is unexpected expenses. There's a small number of Australian lenders that are offering 35 years as a maximum loan term, and with that option, Jake's repayments could be lowered to $3,979 per month, which gives Jake more of a buffer, but that buffer could soon disappear if interest rates rise above 7%. If you want more content about financial literacy so that you can make a more informed decision about your money, then smash that subscribe button. Moving on to the next option. Interest only means just that. Jake is only required to pay the interest charges and not the principal of the mortgage for a limited time. And this is usually 1 to 5 years in Australia. Interest only can help Jake reduce his monthly amount, but it also means that his loan balance won't go down. At 7%, Jake will pay $3,634 per month, which he can afford. But the catch is that most lenders, if not all, will charge a high interest rate on interest-only loans, as high as 0.5% or more. So we need to use 7.5% and not 7%, and that would mean a repayment of $3,894 per month on an interest-only loan. At this stage, you might ask, why wouldn't Jake just go on an interest-only loan for the maximum of 5 years to wait out this wave? The reason is that Jake needs to consider what his repayments will be after the interest-only period ends. The maximum loan term hasn't changed, so repayments need to be adjusted to reflect the amount that's required to pay off the principal within the remaining loan term. In Jake's case, he currently has 24 years left, and if he chooses to be on interest only for 5 years, then he will only be required to pay interest only during that time. After this expires, Jake's loan will revert back to principal and interest. So he needs to pay off $622,907 within the remaining 19 years. If not timed right, the delay of paying off the principal of the loan could backfire very badly. So extending the loan term and interest only could be options that Jake can consider, but what if the interest rate keeps going up? Well, there's one more option that we haven't explored yet. Jake could fix his loan. Again, Jake probably won't get the 2% that he got previously, but it's worth checking out. As of June 2023, the average fixed rate from Australian lenders is 5.8%. And if we use a comparison lending side, we can see a list of variable and fixed rate options available. eBOOK, which is an online lender that is part of the NAB group, is offering a 1-year fixed rate of 6.33%. And with a loan term of 30 years, Jake's repayments would be $3,868 during that year. Interestingly, eBOOK is one of the few Australian lenders that do offer 35-year loan terms. And with a 35-year loan term on a fixed rate of 6.33%, Jake's repayments could be lowered to $3,691 per month, much more manageable. Full disclosure, I have no connections whatsoever to eBOOK or any other sites that I mentioned in this video. These are just examples. You need to do your own research in order to find the best option for your situation. Fixing the rate will give Jake some breathing space and some certainty for the coming year. And if Jake does decide to go down the path again of fixing his mortgage, then Jake needs to consider whether he can lock in that rate with his lender now, because any rate that we see today could change depending on what the Reserve Bank does with the cash rate. Most lenders will have a service where you can lock in the fixed rate for a fee, but there's always a chance that interest rates might go down. Also, Jake needs to consider how extending the loan term could impact when he can retire. What do you think Jake should do? Do you think interest rates will go down and take the gamble with a variable rate, or should he fix his loan again? Let me know in the comments below. Of course, Jake is just a case study to show you some of the things that you may need to consider as a borrower. Your situation could be different, so don't take this as a one-size-fits-all solution. The key is to be informed, plan, and take action as soon as you can. Do you want to be mortgage free? Watch this next video where I'll show you 5 simple, safe, and proven ways where you could pay off your mortgage fast and potentially save more than $280,000 on interest charges. Thanks for watching.